How many years of your life would you trade for a house? Forget the mortgage for a moment. Forget the monthly payment. Compare the full price of a home to what you earn in a year. How many years of your income does it take to buy a median home? In 1950, the answer was about 2.5 years. In 1900, the answer was 11 years. In 2026, the answer is somewhere between 7 and 10 years. Most people assume the story runs in one direction, that housing used to be cheaper and has only gotten harder. The numbers are more complicated than that. 1900 and 2026 are not as far apart as they seem. And the era most Americans treat as the normal baseline for home ownership, that 2.5 year window, was not the norm. It was a temporary policy experiment. It is now farther in the past than the Great Depression was when it began. Before we go decade by decade, you need the measuring stick, because this video lives or dies on one number: years of income. That is the metric. Take the median home price for a given decade, the price of the home right in the middle of the market, not the cheapest and not the most expensive. Divide it by the median annual income for a worker in that same decade. Adjust both numbers to $2,026, so every era is on the same scale. The result tells you how many full years of salary you would need to buy that home outright before any mortgage. Mortgage terms matter too, and we will bring them in later. A 1900 balloon mortgage and a 2026 30-year fixed at 7% create very different monthly burdens. That makes mortgage structure a second lens, useful context, not a replacement for the core ratio. One caveat before we start: pre-1930 home price. Data is reconstructed from sampled census records. The method has uncertainty built in. When the numbers say 11 years for 1900, the real figure could be a little lower or a little higher. We are not chasing false precision. We are looking at shape, direction, and order of magnitude. Now let us go back to 1900. 1900. A median American home costs the equivalent of roughly $196,000 in today's money. The average worker earns the equivalent of about $17,000 a year. Do the division and you get 11 or 12 years of income. That is high for a reason. Homes were not expensive by today's standards. Wages were brutal, and the mortgage system was built in a way that worked against ordinary people. There was no 30-year fixed rate mortgage in 1900. There was no federal insurance on home loans. The standard product was a balloon mortgage. You put down 50% of the purchase price in cash. You borrowed the rest for 5 to 7 years. Then the full remaining balance came due in one payment. If you did not have it, the bank foreclosed. There was no safety net. You either had the money or you lost the house. Think about that practically. A coal miner in Pennsylvania could save for years to scrape together a down payment, make every payment on time, and still lose the house because he could not produce a lump sum at the end. That was not a rare edge case. An Italian immigrant named Giovanni Rossi did exactly that in the Pennsylvania coal fields. He spent years saving for a $4,200 row house down payment. He got there by 1930. He lost the house at a sheriff's auction in 1931, one of hundreds of thousands. By 1933, 1 in 6 urban homes in America had gone through foreclosure. The home ownership rate sat at 44%, about where it had been in 1890. 40 years of wage labor and the needle had barely moved. The 1920s did not fix it. The economy boomed. GDP climbed. Ordinary workers did not see that translate into affordable housing. Mortgage terms stayed the same. Wages did not keep pace with home prices in major cities. Speculation, especially in places like Florida, pushed values up and then sent them crashing down. The years of income number stayed in the 9 to 12 range across the decades from 1900 to 1930, consistently hard, far out of reach for most Americans. So when did it get better? The turning point starts in 1934 with the Federal Housing Administration. The FHA did not just offer cheaper loans. It helped create a new kind of loan for the American residential market, the 30-year amortizing mortgage. Every monthly payment reduced both interest and principal in fixed, predictable installments for 30 years. No balloon, no lump sum, no shock at the end. For the first time, a worker could look at a monthly payment, compare it to a paycheck, and decide whether it was sustainable. The math became human scale. Then, in 1944, the GI Bill added another powerful tool. 0 down payment, 4% interest. Federal guarantee. A qualifying veteran could walk into a bank with no money and leave with a mortgage. The years of income number collapsed. It fell from around 9 or 10 years to about 2.5. The home ownership rate rose from 44% in 1940 to 55% by 1950, then to 62% by 1960. Levittown, New York makes the shift visible. A 4-room house for $8,000 available to an auto worker earning about $3,200 a year, 2.5 years of income. This is the golden window. It was the biggest improvement in housing affordability in American history. For the people it reached, it changed everything. But the window was not open for everyone. FHA appraisal rules were built on neighborhood grading maps from the Homeowners Loan Corporation. Those maps colored neighborhoods across hundreds of cities. Green meant desirable. Red meant hazardous. And the hazardous label was assigned systematically to neighborhoods where Black Americans lived, regardless of the quality of the homes. That is where redlining comes from. It was federal policy. Of the 11 million veterans who used the GI Bill, an estimated 1.2 million Black veterans were largely shut out by local bias, loan rejections, appraisal manipulation, and neighborhood exclusion. Black homeownership stayed near 41% through the 1960s, while white homeownership climbed toward 70%. The 2.5-year figure described white America primarily. The golden window was real. It was also unequal, and it became the benchmark every later generation compares itself to when it asks whether home ownership used to be easier. The window did not close all at once. It narrowed over 3 decades. The first force was inflation. Through the 1970s, consumer prices rose quickly while wages lagged in real terms. Home prices, helped by the post-war construction boom, began to pull away from incomes. The years of income number moved from about 3 years in 1970 toward 4 and 5 by the end of the decade. The second force was interest rates. By 1979, inflation had become severe enough that Federal Reserve Chairman Paul Volcker pushed rates up aggressively to break it. Mortgage rates hit 16, 17, even 18%. A home that looked manageable at 4 or 5% became impossible at 3 times that rate, even if the sale price did not change. An Iowa farmer who bought land in the late 1970s later faced a reset he could not cover with harvest income. The bank took the farm. Across the Midwest in 1982, farm foreclosures spiked, and with them a wave of financial damage that the price to income number alone cannot show. The third force wore the mask of generosity. Starting in the late 1980s and accelerating through the 1990s into the 2000s, deregulation and new mortgage products let banks offer loans to buyers who could not truly afford them. Adjustable rate mortgages, stated income loans, zero down subprime loans. On paper, the years of income number in 2005 looked manageable, maybe 6 or 7 years, because the monthly payment had been pushed down at the start. The 2008 crash stripped away that illusion. 10 million foreclosures showed what had really happened. Home prices had pulled too far away from incomes. By 2009, the ratio had climbed back toward 8 or 9 years, a level not seen since the 1920s, which brings us to 2020. For about 18 months, something unusual happened. Mortgage rates fell to historic lows, below 3% in some cases, while the pandemic changed where people wanted to live. Monthly payments briefly became manageable again for buyers with savings or existing equity. Home ownership ticked up slightly, then rates doubled, then they kept climbing. By late 2023, the 30-year fixed crossed 7%. Median home prices, which had surged during the low-rate period, did not fall enough to balance that out. They mostly held. A dual-income household earning $95,000 a year now faces a median home price above $400,000 in most American markets. That puts the burden at roughly 7 to 10 years of household income before the down payment, property taxes, or insurance. That is the same range as 1900. The mechanism is different. There is no balloon mortgage, no 50% down payment, no lack of fixed rate financing, but the core ratio of price to income has returned to its pre-golden window baseline. The golden window is now farther in the past than the Great Depression was when it began, and yet it still serves as the standard every generation uses when it asks whether home ownership is affordable. It shapes the political debate, the family arguments, and the advice people give each other. It lingers like a policy experiment most people have forgotten was a policy experiment at all. So what happened? How do we explain a century of economic growth, technological progress, rising wages, and rising productivity, and still end up in roughly the same place? The answer is not a single villain. It is not one law, one president, or one bad decision. The golden window was never the natural state of a free housing market. It was built from specific instruments: federally insured long-term mortgages that changed the risk for banks, wartime and post-war wage compression that kept price and income unusually close, a mass construction boom that added supply quickly, and interest rates held low by policy and by global conditions that no longer exist. When those supports faded, through inflation, through deregulation, through housing becoming a financial asset, through zoning rules that restricted new construction, the metric moved back toward its older baseline. Not because the system broke, because the thing holding it open stopped holding. The 1940s through the 1970s were not the default pattern for American housing. They were an experiment. A generous, partially exclusionary, genuinely transformative experiment that lifted millions into the middle class and gave many families equity to pass down. We have been living outside that experiment for 50 years. The golden age of American homeownership was not history's default. It was a 30-year policy experiment, and we have been living outside it ever since.